Today, let me analyze a slum sale situation which on paper looks very simple, but most of the tax and deal issues arises because of its improper implementation. Let me first start with the undertaking test. Slum sale means a transfer of business undertaking comprising of assets and liabilities. Two important points to note here is that a typical pick and choose approach may not work, and the assets and liabilities should be clearly identified and documented. If your undertaking test fails, the transaction may not qualify as a slum sale at all. Let us understand the capital gain computation for slum sale purposes. From an income tax perspective, the capital gain is computed by taking a difference between the sale consideration and net worth of the undertaking. The sale consideration is determined as higher of the agreed consideration between the parties or the consideration determined as per the income tax valuation rules, which is the deemed consideration. One of the most important points that many people miss is that for computing the net worth of the undertaking, the income tax WDV of the fixed asset is required to be considered, and for computing the deemed consideration, the book value of fixed assets is required to be considered. So, if there is a mismatch between these two values, it may lead to tax complexities. Now let us understand the timing. When you see a business transfer agreement, practically there are three different dates. One is the signing date, second is the closing date, third is the effective date. From an income tax perspective, the closing date is generally considered as the date of transfer. Aligning these dates properly is a very critical structuring input. Let me talk about the consideration now. The purchaser may discharge the consideration to the seller by way of cash or by way of issue of its own shares. There are certain working capital adjustments which needs to be factored in between the signing date and the closing date. Now that you have understood the income tax aspects of it, let me also share some of the practical complexities which arises in a slum sale transaction. Number one is the employee related transfers and their emolument transfers, which needs to be carefully structured and planned. Second is the vendor and customer contracts negotiation. Third is the lease transfer, because improper structuring of lease transfer may lead to stamp duty implication. Fourth is the GST. While generally the business transfers are exempt from GST, but you have to file certain forms in order to transfer the input tax credit. And lastly, if you are transferring the substantial undertaking from the company, you have to obtain a shareholder resolution in general meeting. Aligning all these areas is a very critical structuring input. To conclude, the slum sale transaction may effectively be implemented in 1 to 1.5 months starting from structuring till implementation. If you are stuck in any structuring complexity with respect to the slum sale or any execution related complexity, I can offer a 15-minute exploratory call to discuss your situation. Follow me for more updates on tax, structuring, and other regulatory inputs. Thank you.